Hey, before we get started, just a quick reminder, any advice in this podcast is of a general nature only and has not been tailored to your personal circumstances. So please seek personal financial advice before acting upon this.
Hey everyone, and welcome back to another episode of Cash Talk. Today I'm joined by Chief Economist of BetaShares, David Bassanese. We'll be unpacking the current state of the economy and how it is affecting investments. Now, for those unfamiliar with David or haven't seen him with me before, David is responsible for developing the economic insights and portfolio construction strategies for advisors and retail clients, or essentially mums and dads. Okay. Prior to BetaShares, David was an economic columnist in the AFR magazine, or AFR articles over the last decade or over a decade. Prior to AFR, David spent several years in financial markets as a senior economist and interest rate strategist at BT and Macquarie Bank. He started his career in the Commonwealth Treasury as a Commonwealth Treasury official, after which he spent 3 years as a research economist for the OECD in Paris and France. So I might have to speak to him about that one. David is the author of 2 online investment books, including Australia's most comprehensive book on local ETF market. He graduated with first-class honours at the University of Adelaide and a Master in Public Policy and from the JFK School of Government at Harvard University. David, thank you very much for joining me again today.
Good to be with you, John, and happy 2022 to you and all your listeners.
Thank you very much. And so, mate, before I get into everything, you're going to have to speak to me. How was your time over in Paris and in France with the OECD?
Yeah, no, it was good. I spent 3 years there. It was an exchange program that I was at. They used to have an exchange program with the Treasury Department in Canberra, so they'd send a young gun economist, I guess you'd call them, or something.
Mm-hmm.
But problem is they never tended to come back because the OECD would offer them jobs, and so same with me. After a year there, I stayed on in the role. So yeah, it was a good few years and enjoyed it. But I realized that I didn't want to spend my whole life there. I had other things to do, so I did leave after a while.
Yeah, no, that's it. It's very interesting, being abroad, obviously, as well, too. You've studied at Harvard University and there's a bit of a kit bag as well, too, in regards to, public policy and stuff like that, which we're obviously going to go a bit in today around, fiscal and monetary policy as well, too, which is a bit of a topic now. But listen, listeners, before we get into it, viewers, before we get into it, we just want to make sure that everything that we're talking about, just a bit of a reminder, is general information only. We haven't taken your personal circumstances into consideration. So please, before doing anything, please go seek professional personal financial advice, okay? That's tailored to your needs, okay? So before we get started into the money stuff, I just want to know, Dave, I've known you for a little bit, but I've never asked you this. How did you get into the world of investments? Like, where did it all start for you?
Well, I mean, I studied economics at school, and so I, did economics at uni. So I started as an economist, and initially, with a public policy point of view. So I started at Treasury and was doing public policy, and then I discovered financial markets because many of my friends were moving to the merchant banking, as it was called back in the day, in Sydney. So people were leaving Canberra to go and work as economists in the financial markets, trying to second guess what the Reserve Bank was doing with interest rates. Some became fund managers, and so that's eventually sort of down the path I went. Working in markets can be exciting, and it's obviously fairly reasonably well paid, better than public service. Though the public service these days they are a lot better paid than they were when I first started. So yeah. But that's, how I got into it. I got into BetaShares because I liked exchange traded funds when I discovered what they were, because they allow for sort of macro type of investing, top down investing rather than bottom up investing. One thing led to another, and I saw the potential of them in Australia, and so that's why, I kind of came to an arrangement with BetaShares to come and work with BetaShares to help promote their company and the products generally.
Yeah, awesome. And it's obviously been a journey. It's great to see so many skill sets being used in different areas, which is amazing, Dave. Now, there's a lot going on in the world of investments at the moment, Okay. And what I really wanted to pick your brain, and as you can see for listeners and viewers, I'm trying to get the best person in the job to unpack this. Inflation. You know, I think even clients at the moment now know what inflation was. I think you used to have to explain to them what it is, but in the headlines, it's inflation, inflation. And only yesterday, a client sent me a picture of, he got a coffee, I think it was like last week, and it was $4.50, and it's now $5.50.
Oh, my goodness.
Yeah, so he's feeling the pinch. Yeah, he's feeling the pinch. But, you know, let's talk about, you know, inflation, okay? And there's obviously talk around, you know, central banks across the world, RBA, US. One is maybe when it's likely to happen, but also like, what do we see, you know, what do we see it playing out like? And maybe if we can just, like, what are the concerns? Because obviously these concerns about inflation are both at the domestic level or at the home level, but there's also at the institution level and at the fund level where they're just like, you can see on equity markets, it's really creating volatility.
Yeah, I mean, I think in terms of, you've got to unpack what's driving inflation. So there's a few things. Now, first and foremost, basically COVID was, you know, COVID was a supply and a demand shock. So it was a negative supply shock because different countries had to close down at different times. So it disrupted production, disrupted factories, you know, disrupted China and Asia, which are, you know, the factories of the world. At the same time, it disrupted employment and people lost their jobs, and governments responded to that, and central banks by giving them an enormous fiscal stimulus, you know, money in your back pocket, slashed interest rates. And so, funnily enough, through COVID, we had a surge in demand, like a surge in good demand for goods also, because a lot of services were shut down, you know, travel, restaurants, these sort of things. So people stuck at home, bought a lot of stuff on Amazon, a lot of it that needed to come through factories in Asia, and that supply-demand, you know, choke point, if you like, led to inflation going up. So that's what's happened. It's been a surge in demand coupled with production bottlenecks that have caused inflation to go up. Now, that part in and of itself, it should moderate, you know. So basically, that fiscal stimulus, that monetary stimulus, you talked about central banks raising rates, that is starting to wind down, and goods demand is consumer demand is slowing, and also the switch back into services as we open the economy. And, you know, Asian factories are starting to open up again. So those sort of bottlenecks, generally speaking, should ease. And so the high inflation rates that we see, you know, in the US, it's running at 7%, you know, headline inflation is at 7%. Here, it's only around 3% or so. So we don't know, our problem is not as bad as it is in the US. But so that should ease and help by the central banks raise, and that's, you know, we can touch on this in a minute, but one of the things central banks are doing is, you know, they slashed rates to zero, but now they're saying, you know, the emergency's passed, we've got to make sure the economy does slow, we've got to make sure that this inflation that we're getting isn't embedded into inflation expectations. You know, if people expect inflation to be 4%, they're going to start demanding wage rises of, you know, 4 or 5%, and that's how it gets embedded. And that's how it got embedded going back to the 1970s when it had an oil price shock. Now,
it's very interesting. It's very interesting just on that point that you were saying before we continue. So COVID has caused this kind of, you know, this shock to the system. Let's talk about it. Governments have stepped in. They've pumped all of this money in. Like I kind of put it, if they're the bank at the monopoly, they've just thrown it all on the table, to kind of make it still the wheel go round. But that's obviously shot up this inflation and all of this demand. But we're talking about this now kind of normalizing. So you've got this like massive deflationary period that's kind of sudden, which is this slowdown of the economy due to COVID and all the lockdowns. And then you've got this speed back up. So is there this anticipation that this inflation is short-lived, that it's really just this kind of, it's a lump period, or could it keep going? Obviously anything could happen, but is that what we're more thinking, that it will get back to a bit like normalized levels?
Well, I mean, that again, so the thing about it is that the hit to the supply demand imbalance that we've been dealing with, the disruptions of COVID, those should ease. But the two ways in which inflation could linger is that, again, if it's embedded into expectations. So, you know, the longer, and so this time last year, we anticipated inflation would pick up, and I'm talking about the US in particular here, but it's also true in Europe. what happened is we did get that inflation pickup. It was a lot more than expected, and it's lasted a lot longer than expected. So, but the causes of it are the same thing. It's still the supply-demand imbalances, which should moderate. It's just been a bigger hit, and it's lasted longer. And so central banks have lost patience in the idea that it's going to be temporary. They want to just make sure it is, it doesn't last for another year, for example. They want to see it to moderate. So I think that should moderate because central banks are going to, raise rates and ensure that growth does slow to a degree. The lingering problem, and the last point I was going to mention, is we are left with tight labour markets in many countries, particularly, again, the US. So the US unemployment rate is 3.9%. Wages growth are growing at 4 to 5%. So that is high. And that's, if it stays that way, the central bank may need to raise rates, quite aggressively and actually slow growth, more than just a gentle slowdown, which is what everyone's hoping for. So that's the lingering concern. But again, it's not that inflation will persist because central banks will kill it one way or the other. But what we don't, ideally they kill it, it's the medicine is not too harsh. But I think inflation will ultimately moderate because central banks will insist on it. But hopefully that the medicine they need to, provide to the economy, it won't kill the patient in the short run.
Yeah, and it's this
tight, make it very, very sick. Yeah.
Yeah, and I was speaking to another one, another person just recently, and we were just talking about this, just getting the timing right. And I think this is where the equity markets are kind of just so nervous as well. It's just if they go too soon, are they pulling it too soon? Are they going too late? And this kind of uncertainty is causing what's going on.
Yes.
And so, when we talk about now the flow, and it was great that you kind of gave us the insight about how the central banks are kind of thinking and whatnot, but then the flow onto the equity markets. Obviously, we're very leveraged in both. Well, we'll go into the property market as well, but the equity market and the property market. And it's just when we take it down, really, we can also even talk about crypto market as well too. It's just there's so much kind of debt circling around and cheap money that soon as we're hearing these kind of interest rates going up, and we're hearing banks, we're talking the big banks, increasing their fixed rate home loans. And so people are anticipating these interest rates to go up. Do you see the volatility that's happening in these asset classes nearly closely directly linked to what's going on at the moment? And if so, how is this turning out in the short to medium term?
Yeah, so look, the first round so basically bond yields, bond yields have been low for a long time, and what that's done is allowed equity valuations like price to earnings valuations to go up. So the equity market is expensive on a price to earnings basis simply because interest rates are so low and people have been forced to invest in the equity market. Now, as interest rates go up, that PE value, so again, in the US, the PE is at 20. The average since about 2013 has been about 17.5. So it's still a little bit somewhat above its longer run average. And if you go back 10, 20 years, it's been 15. So the fact it's at 20 is still pretty high. So there's two stages to this. The first stage is interest rates going up, putting downward pressure on PE ratios, which is what's happening at the moment. The second stage, and the stage we hope we don't get into, is where interest rates actually slow the economy by enough that we also see earnings falling. Because at the moment, earnings are still growing pretty nicely. So all we're seeing at the moment is what I call a valuation-led correction in the equity market. It can get worse if we also get an economic slowdown, earnings slowdown, and that's then the next leg of the potential equity market correction. So talking about a delicate balance, I think what they're trying to do is have a soft landing, quote unquote, for the economy, such that valuations come off, but earnings aren't hurt too badly. I think at the end of the day, we've probably still got a bit more downside to come. At the bottom of the market of the US a week or so ago, it was a 10% correction. I wouldn't be surprised if it can be as bad as maybe even 15, possibly 20% fall. But barring the US tipping into recession, which again I can't see happening anytime soon, it should be limited to something like that. But that's as far as my crystal ball can extend, that's sort of what I'm suspecting at the moment is going to happen.
Yeah, and I think you hit the nail on the head. Like, we don't want to get caught up in the whole kind of crystal balling scenario, and we're trying to work with the facts that we've got and what's presented with us and what's showing in front of us. And I think that, you know, this volatility, like we can see, is very much about these decisions that are being made, and the market is very, very good of picking up on bad news. You know, on good news, yep, it'll fly. That's cool. Yeah, but on bad news, it shivers. You know, and it really kind of gets to the bottom. But one thing we're experiencing locally now because of this kind of interest rate is that, you know, I've been personally in the property market for close enough to a decade myself personally, and I haven't experienced interest rate rises. I think there might have been one along the way. Do you know what I mean, Dave? Like, this personally, obviously I'm you know, I'm trained and, you know, educated a lot in it, but if you think about that, you've got you've got first home buyers, you've got maybe potentially second home buyers, you've got young families who haven't really experienced an interest rate rise and maybe don't have good cash at bank. You know, they're not prepared for these interest rate rises. And so when there's talk about it, we're also starting to see for the first time, I think it was in Sydney and Melbourne, or not in the first time in a long time, capital cities starting to get flat in regards to their data, in regards to home valuations. You're starting to see some heat coming out of the market. So, you know, what's the thoughts around, you know, the local economy in regards to like property and stuff like that? Is it a big concern? Because there is a lot of debt floating around.
Look, yes and no. I mean, yeah, you're right. Like, I think the RBA hasn't raised interest rates in about 10 years. So, you know, it's been 10 years. It's been a one-way train since for over the past 10 years. It's been quite extraordinary. Yeah, since the GFC, basically, the initial rate increases in interest rates after they slashed rates during the global financial crisis, which is getting on now, some time ago. What happens now? So they slash rates. Yes. So we had an almighty housing boom. In fact, I wrote a blog early last year saying house prices were going to take off. And, you know, I didn't put a number on it. Some people put numbers on it, but I did anticipate, 10, 20% sort of growth. And, I think it was closer to 20%. But it just shows you that house prices these days are very sensitive to interest rates. And it's because what happens is, when the Reserve Bank cuts interest rates, people don't say, I can now don't have to spend as much on a mortgage. I can go and buy a house and buy a better car. They just mean, it means I can spend even more on a house. And so everyone goes out to the auction and bids up to their maximum capacity to pay off a mortgage. And that's why it's the marginal affordability of a property that's driving prices. And so when interest rates go down, prices go up and vice versa. So, I would anticipate as interest rates go up, presume, depending on how far and how fast, I don't think they'll go up rapidly because, again, we don't have an interest rate inflation problem to the extent other countries do. So I'd anticipate the RBA may raise rates 4 times over a year. So we go from close to 0 to maybe 1. And then over the next year, maybe up to 1.5, and we'll see what happens thereafter. But that's still 1.5%. And I reckon house prices will come off, in nominal terms, maybe, 5-10%. Again, some are saying a crash, but I can't see a crash, unless there's, again, it's associated with a downturn in the economy. But if that's the case, then the Reserve Bank will turn around and cut interest rates again. So
it's just an interesting thing. Like, for listeners and viewers out there, you can kind of see how much this one kind of lever, with the central bank's card is just sends ricochets across them all. We could talk into like crypto and stuff like that, and this is a very similar scenario. Just the sensitivity, of interest rates, and for the listeners and viewers out there, I think the biggest thing is to always remember, we've had it good for a long time, and so it probably has some tips is to just making sure that there's cash available. Anticipate for things to potentially go up. It can't be roses forever. And so, just better preparing yourself. And if you don't feel comfortable, go seek financial advice to help you build those things and make sure that your assets are allocated correctly, as well to accommodate. Because, Dave, as we know, there's a lot of asset classes that do love inflation. So we have talked about, for example, some things that are sensitive, but there's also assets that like inflation, okay? And so, we don't have time today to go into it, but making sure that, when we're structuring portfolios, we're not just structuring them in asset classes on the downturn in regards to inflation, interest rate going down. When interest rates go up or inflation goes up, there's good recipients on the other side. Exactly. At BetaShares, you do this all the time, and so do we in regards to making sure that portfolios are adjusted correctly for these circumstances. Now, the other two things that I just wanted to have a bit of a chat about, and this is more international news at the moment. One is around this lingering kind of Chinese property issue, okay?
Yeah.
Late last year, it was really kind of front page headlines about, Evergrande. But, diving deeper, it sounds like there's a lot going on. I can't remember off the top of my head around the biggest property development, Garden, what is it? Evergrande is the second, they're the biggest one. But they were talking around, even them being unstable. What's BetaShares' view in regards to this lingering property issue in China? Is it bigger? Should we be more concerned than what most people are? Like, word on the street is at the moment there's no word on the street. And the more I'm looking at it, it's very quiet about it.
Yeah, look, you don't get a lot of clarity in China about what's going on. A lot of things are going on behind closed doors, and obviously the media there aren't as able to report about things to the extent you would get, say, in Australia or the United States. So not a lot of clarity in terms of what's going on. But what we think we're seeing is that there's been a lot of rationalization and more profitable property developers trying to take over the unprofitable ones to keep projects going. And containing the debt fallout. I think there's a lot of property developers that racked up a lot of debt, and to the extent that then they can't sell their properties, and people basically balk at committing to buy the properties ultimately. You're seeing banks they're just doing debt rescheduling with the banks, and again they've borrowed money from state-owned banks, so the government can sort of get the banks to sort of do what needs to be done to sort of stop things blowing up. So that I think they're slowly in the Chinese way dealing with it piecemeal, gradually putting the finger in the dike when something leaks, and hopefully the thing doesn't implode. So I don't think China is going to. I'm more concerned about the US and wage inflation and interest rates than I am about China being a source of major risk to global markets. But I think,
this is ultimately what we're talking about, Dave. And this is where I'm going about it. The talk from some areas is that this is the one that will bring it all down. Yeah. And
there's been that talk for a long time. Yeah.
Do you know what I mean?
And maybe one day it will happen, but it's hard to.
It's hard to predict, but it's just like this big situation, and because of this kind of world of secrecy, and it's obviously a land of unknown, there's a lot of unknowns in the unknown at the moment, Just to paint it in, I was reading the other day that the number of empty buildings, just to put it in perspective, was 27 times what's in Manhattan.
Right, yeah.
So we've got to think about it. It's a huge thing, but in perspective, and this is for the listeners and viewers, you got to remember, you've also got 1.4 billion people or whatever it is, with a large portion of them coming out of like farms and stuff like that, and are starting to be urbanized, And I've been to China, Dave. I'm not sure if you've been there yourself, but I have been fortunate, and I know that the way that they run their stuff is when they build a freeway, they don't build it 2 lanes first and then 3 lanes and 5 lanes like in Melbourne and Sydney, and then you've always got this congestion going on. They build 8 lanes first, wait for the traffic to come, which will be in 20 or 50 or 25 years later. And so when it came to this building philosophy, it's very much similar to that. They know that in a decade's time or in 15 years' time or 20 years' time, you've got a big chunk of this population that's being urbanized, so exactly. They need to be housed. So we've got to be, I know there's a lot of stuff, and remember, people are trying to sell papers here and magazines and whatever it is and news based on greed and fear, okay?
Yeah.
It's also, when I take a step back and I look at the situation, I also look at it from a planning perspective. Yeah, they're also planning for these people to come in. That come in there. So, it's going to be an interesting situation. But the kind of building requirements, or call it supply and demand. Yeah, there's a crap load of demand when you think about how many people are actually going from the houses and huts, into urbanized living.
Yeah, exactly. That's right. And, it's a massive country with a huge population. So, the number of times that sounds a lot by Manhattan standards. But as you said, like, you've got to build, all buildings are empty once they've built, and then, you fill them up. But, and depending on the speed in which that happens. But, we've been hearing these stories about, ghost towns, empty towns that have been built, but they've all managed generally to get filled up eventually. People are buying off the plan, essentially. That's the way a lot of these things work. And, ultimately for Australia, you look at iron ore demand, it's still going through the roof. So, as long as they keep demanding iron ore, it's happy days for Australia in terms of that relationship.
That's it. We hopefully that relationship gets a little bit better, because over the last bit it's been a little bit of tension. And talking about tension, well, I can't help myself but think that Vladimir Putin just likes to stir the pot. Yeah. But the reality is that we're now got a situation where Russia is at the borders of the Ukraine from all news reports. And for a little bit of interesting facts, when the Soviet Union kind of got after the Cold War kind of got separated, Joe Biden was actually the guy who kind of got the Ukraine and everyone into NATO. Okay, so this is why I say that I feel like Vladimir Putin's like poking at everything and stirring the pot, because obviously Joe Biden happens to be the president now. But in saying this, Joe Biden's kind of coming out pretty interestingly saying, we're here to back the, Ukraine, and we'll be there to support NATO and all of that stuff. And Russia at the border. What does this mean for global markets? And when we're talking about tense scenarios like this one, what does this mean? And this smells a little bit like North Korean issue from maybe, I think it was like 2018. Smells a little bit like that. What's these so-called geopolitical risk factors, they're very hard to get your head around from a financial point of view, because ultimately, look, if Russia, let's say Russia does invade the Ukraine, and takes over the Ukraine, in terms of the global economy, not that much will change. There'll be a lot of sanctions imposed on Russia potentially, so the Russian economy may suffer to some extent. Or the first and foremost thing that will happen in the short run is oil prices will probably go through the roof, like go even higher. So that will add to inflationary concerns in the short run. But then you would anticipate OPEC still have spare production capacity, particularly Saudi Arabia. So if there was a crunch because of, for example, they may ban, oil exports or something from Russia, but then Saudi Arabia could open the taps. So funnily, a lot of these geopolitical tensions, it's sort of, you've got to distinguish between, obviously horrible, and we don't want to see Russia invading Ukraine, but will it lead to a, global bear market? No. Will it lead to some volatility on the day it happens or the week it happens? Yes, probably. But generally speaking, sell-offs due to geopolitical concerns are often buying opportunities because, they tend to be fairly isolated, they don't lead to broader contagion. And I think, US has put troops into Poland and, some of the other countries. I don't think it's put I don't think it's at the border with the Ukraine. So if Russia did go into the Ukraine and maybe not take over the whole country, but take off another slice of it, that's what I suspect. The worst case scenario is they go in and take off a slice of it where there's a lot of ethnic Russians. People will, jump up and down, scream, but then life moves on basically, and Putin probably knows that. And this is the thing. So we just got to understand, and David unpacked it very, very well. Just like from a financial markets perspective, what's the impact? Okay. It's just, we've got to remember that a lot of news these days is bad news. And what I mean by that is take out whatever it is. I'm not talking about the Russian and Ukraine issue. I'm just talking about news in general. Yeah. And a tip for me, and I've been focusing a lot on it, is trying to block out a lot of the noise when it comes to the financial stuff. Obviously, from a humanitarian perspective, we do not want war and all of this stuff, we don't want that. But from an actual markets perspective, trying to block out that noise is very important. Which probably leads me to, mate, just, I don't know, the young couple investing first and starting off, or the young one who's getting in. You've been there for many, many years now. Dave, maybe what's some 2 or 3 tips that you could maybe give these people, or even, general investors? I'm talking about the novice investor, really.
Yeah.
Maybe 2 or 3 tips walking into 2022.
Look, I think in the short run, the markets are going to probably have a bit more volatility. There's probably a little bit of downside, but again, from a long-term perspective, that could be actually a good buying opportunity, and particularly in some of the technology areas that are being hard hit now by interest rates going up. So, things like the tech stock, Google, Amazon, Facebook, these sort of companies are, pristine companies with very strong business models, very strong balance sheets, very good earnings. And to the extent they have a pullback here because of interest rates, that could be a good buying opportunity to get into some of those areas. The other, as a general rule, again, as a provider of ETFs, these days you don't have to, if you want to pick stocks, fine, but you can get broad diversified exposure to equity markets now pretty easily through various, ETFs that are on the market. So don't think you need to be a Warren Buffett and be able to pick stocks to invest in the share market. You just have to, have a broad exposure to the market and let the market do its work. Would be the other, I guess, tip I would have. Finally, if you are a younger investor, take advantage of the fact that the greatest asset that you have is that you can have a long-term time horizon. If you're 70 or 80, you do have to be more worried about the market. Whereas if you're investing gradually over time and the market has a pullback, you should actually see that as a cause to celebrate, because you can buy more stocks at a cheaper price.
Well, it's actually funny, Dave. This time factor is interesting. I feel like I'm trying to figure out what age it is where time turns from your best friend to your worst enemy. It's like, when does the pendulum swing? And, for the younger investor, yes, time is your best friend. Yeah. And this is why we try and say, it's time in the market, not timing the market. And it's very important. And you bring up like Warren Buffett, and, there's many others like Warren Buffett, but if we just use him for an example, he actually talks about, most people not stock picking, not actually trying to find stocks and actually diversify and use, a version of an ETF or an index or a fund. And, diversification is a very, very important thing when you're talking about, remember we talked about before about inflation and the different kind of aspects, and diversification helps to fight that as well too.
Yes.
I think the only other one that just came to mind before I let you go, Dave, is we've talked a bit about doom and gloom, and they were great kind of tips, and I think that they're great ones. But is there any particular sectors or particular areas that are maybe just thriving? Because I tend to see that there's a lot that are doing really, really well, and then there's others that are unfortunately doing poorly. Is that what we're seeing in BetaShares as well too? Are they seeing some sectors that are really kind of flying in the current environment?
Well, look, broadly speaking, what we're seeing at the moment is what's called a growth to value rotation. So the high-flying tech companies that everyone loved last year are having a pullback because they are a bit more sensitive to interest rates. And some of the unloved, beaten up value areas of the market, like global banks, global energy companies, like people don't like to invest in oil companies anymore because of, environmental concerns. But as a result, they're still pretty cheap and churning out good money given where oil prices are. So we're seeing unloved, beaten up areas of the market like energy and financials doing pretty good compared to the more glamorous Google, Amazons, and Facebooks, and the Nasdaq index, for example, and some of the more even Tesla, for example. So that's areas that are from a sector point of view doing relatively well at the moment. Now, some of these other companies, I mentioned technology. Some of these companies that don't have a lot of earnings, and I won't go into specifics, but some companies are still thriving in terms of disrupting industries and carving out niches for themselves. They may not have a lot of earnings at the moment, and they've traded at high PEs in anticipation of all this growth ahead. They are, as businesses, still thriving. It's just that they traded at such a high PE that's now coming back to earth. So if you just looked at the share price, you say, "Oh my goodness, it's a failure." But no, it's just the market took them too fast, and they're coming back down to earth. But the actual underlying disruptive technologies that they're dealing with, and I'm talking about robotics, cybersecurity, Asian technology companies, even in the US, a whole manner of disruptive technologies, they're still thriving. It's just their share prices are coming back down to earth.
Well said, mate. I think that there's still a lot of good areas that are thriving and still doing well, and it's just as things happen, things move and they never stay the same. And probably, Dave, me and you remain in a job because nothing is ever constant. It's always moving. If it's
something always happening, that's right.
Always happening. Well, Dave, once again, I would like to thank you for jumping on. Listeners, hopefully that was awesome. David generously passes on his time to us, and I really do appreciate it. Dave, I'm sure I'll see you around. And for listeners, I'll see you on the next episode. And thank you very much. Cheers.
No worries. Okay. Bye for now.
Thanks.